The Business Council has sounded a dire warning that Australia faces falling living standards and the loss of hundreds of billions of dollars worth of investment in resource and infrastructure projects unless it becomes more competitive. In its latest report, Pipeline or Pipe Dream, the peak business body says high costs and low productivity could make Australia too risky to invest in. In a few moments, I'll be joined by Jennifer Westacott, the Chief Executive of the Business Council. But first, as Kerry Brewster reports, some critics are accusing the Business Council of scaremongering.
Australia is risking its future prosperity, says the Business Council. It's too expensive and lacking in public infrastructure. Its mining and construction workers are unproductive. Its population ignorant and unappreciative of the mining boom's benefits. But its latest report has been dismissed by two academic economists.
Certainly, I think the mining industry should stop complaining. They've done very well. They've avoided paying a substantial return to the Australian community on their assets, and you know, I think I've been hearing threats from the mining industry to pack up and go ever since I can remember, and it's bigger than it ever was.
They're basically saying unless we have quite dramatic changes, a new golden age, which is just on the horizon, will not be realised. So, in a sense, what they're trying to foster is a sense of moral panic. Do it our way or we're all ruined.
In what it describes as landmark research, the report reveals how Australia performs in delivering major resources and industrial projects. Australian projects were found to be 40% more expensive than those on the Gulf Coast of the United States. Professor John Quiggin argues there's little value in such a finding.
The central conclusion is wrong because the analysis is based on essentially on costs driven by the high value of the Australian dollar. The high value of the Australian dollar is driven by the mining boom, so really the key argument about cost differentials doesn't make any sense at all. Buried in the report, they have an estimate that if you adjust for the exchange rate, the gap falls to 19%, which is much smaller. Then there's the problem that the Gulf Coast of the US isn't really a good comparator. Of course, certainly not for regional projects in remote locations, which is part of their comparison. But also it's not a competitor for most of the Australian resource projects. Their main activity there is oil and gas. We're primarily focused on coal and iron ore.
The Business Council also found that Australian labour was 35% less productive than labour on the US Gulf Coast and 60% less productive for projects in remote locations.
The southern states of the US have amongst the lowest labour standards in the world, amongst the highest levels of underemployment, and from a social point of view, they have the highest infant mortality rates and the shortest life expectancy. These are not socially desirable places, but you do get very low labour costs in that kind of social environment. And I think if we're looking to the future, I'm not sure that I'd be benchmarking myself to the southern states of the USA.
Ahead of next week's Economic Forum, to be hosted by the Prime Minister Julia Gillard, the Business Council is advocating a more open and competitive labour market. That means more enterprise migration agreements, increased productivity, more government investment in mining communities and a more streamlined approvals process. Kerry Brewster, Lateline.